Welcome to World Business. Now, as head of programmatic for Spotify back in 2016, Dal Gill became famous as the first commercial executive to be hired outside of the US. Well, since then, revenue has tripled to over $15 billion. Now, in his new role at SmartFrame, the scale of the ambition is similar. Well, SmartFrame's mission is to revolutionize the world of digital advertising. Well, let's speak now to the firm's new Chief Revenue Officer. Dal, very good indeed to have you on the show. Some similarities then with what you were doing at Spotify, but now it's the world of online advertising. Tell us about the business.
Amazing. No, thank you for having me here today. So SmartFrame, where shall I start? So very top line, it's what YouTube did for video, what Spotify did for audio. SmartFrame is doing it for images. So ultimately, what we're doing is we're enabling publishers, photographers, and rights holders to protect and monetize imagery in a smarter way. In terms of the markets that we're in, we're predominantly in Europe, but we're expanding out to the Middle East, expanding out to the US as well. And what our technology really does is allows images to be trackable and commercially be valuable, while also creating new premium advertising opportunities around visual content.
Very interesting. So how does the core technology work then, Dal?
So the core technology, how it works and what the aim really is what we're doing is we're bringing authenticity to digital advertising campaigns. So with advertisers in the market right now, what they're really after is high quality, trusted digital environments. So we provide the technology in all of that. So what we do is we give the advertisers the opportunity to serve contextually relevant ads around licensed images. And then we also bring over 50 million authentic images to publishers to use for free, whereas otherwise they would have been paying licensing fees, high licensing fees every month to get those quality images. In terms of the technology, it's really interesting. So we're still using a lot of technology. We're still using AI, but when it comes to the actual image itself and protecting the image, it's really important to state that we're not using AI. We're really distributing quality images that are real, and that's what the advertisers like as well.
Okay, so AI is part of what you do, but not then the be-all and end-all.
Look, AI has had an amazing impact on both businesses and consumers. We've seen is that there is a negative impact when it comes to AI-generated imagery. And, for people, it's hard to really understand what's real, what isn't real, and that really causes doubt. Even advertisers, we've seen various studies carried out within the industry, and advertisers typically want to align with authenticity. And some of those studies suggest that actually ads served in trusted environments deliver up to 30% recall. So AI is great as a tool, as an enabler, but when it comes to content and consuming content, it's more important to be authentic.
Yeah, indeed, more important to be authentic, as you say. The advertising's changed a lot, hasn't it? Where do you see the next big opportunities over the years ahead?
Well, we've seen the rise of influencer marketing, but again, it's all about authenticity. It's not the same thing having celebrity marketing a product that you can't relate to. You'd rather someone where you see yourselves in them and you can relate to that, and that's where what advertisers are also seeing as well. Maybe 4 or 5 years ago, they would have gone with these celebrity endorsements, but now they're really going with those more authentic people out on the web. And where I see advertising going, again, I think AI will play a pivotal role when it comes to probably the running of campaigns, the optimization of campaigns, the research for branding, and even the storytelling part. AI can be used in it, but I suppose when it comes to the actual delivery of it, what brands really want to see is real moments and capturing those real moments with authentic storytelling.
Now, Dal, you're based in Dubai. It's been a pretty tense, pretty tough time in the GCC recently. How are tech leaders like you feeling? And has the ecosystem weathered the storm, do you think?
No, it's a great question. I think, no one's going to lie about this. It has caused short-term uncertainty around global markets when it's looking at the Middle East and GCC in particular. But what has been really impressive for me is how the UAE and the wider MENA ecosystem has had its commitment and given that commitment to innovation, infrastructure, and international investment. So I think that's really important. The way the country has handled communication and support needs to be commended, I believe. And the region still continues to attract talent, capital, and global business because the fundamentals remain strong I'm in various WhatsApp groups where people are still continuing to flood the market, looking for jobs, really see the future here over the next 5-10 years. So definitely short term has been impacted to a certain extent. But for me, personally looking at myself, the roads are busy, children are going to school, restaurants are thriving. So that's still happening.
Dal, many thanks indeed for joining us. Now, the term of the US Federal Reserve Chairman Jerome Powell comes to an end this week. World Business now takes a look back at how it all started, what he achieved, and of course, Mr. Powell's rollercoaster relationship with President Donald Trump.
It is my pleasure and my honor to announce my nomination of Jerome Powell to be the next chairman of the Federal Reserve. Congratulations, Jay.
Thank you, Mr. President.
He's strong, he's committed, he's smart. He's strong, he's committed, he's smart.
In November 2017, the US economy was about to change direction. President Donald Trump chose Fed Governor Jerome Powell, who had served since 2012 to lead the Federal Reserve. Powell was seen as a steady hand and a reliable choice.
Thank you very much, Mr. President, for the faith that you have shown in me through this nomination. And I'm both honored and humbled by this opportunity to serve our great country.
Powell was sworn in on February 5th, 2018, and by month's end he was already signaling a gradual approach to raising interest rates, even as tax cuts and government spending boosted the economy.
My colleagues and I at the Federal Reserve will put everything we have into serving you and our country with objectivity, independence, and integrity.
These interest rate and balance sheet actions reflect the committee's view that gradually reducing monetary policy accommodation will sustain a strong labor market while fostering a return of inflation to 2%.
Throughout 2018, Powell stayed on this course. In Chicago, he reaffirmed the Fed's 2% inflation target. By November, he noted that while risks remained, the financial system was still stable. But the first signs of friction were beginning to emerge as the Fed kept tightening policy.
Over the next few years, we will continue to aim for 2% inflation and for a sustained economic expansion with a strong labor market. My own assessment is that while risks are above normal in some areas and below normal in others, overall financial stability vulnerabilities are at a moderate level. Today, we raised our target range for the short-term interest rates by another 1/4 percentage point.
By the end of 2018, relations between the White House and the Federal Reserve had soured. On Christmas Eve, Trump attacked the Fed on social media, calling it the economy's only problem and comparing it to a golfer who can't putt. Powell, however, remained defiant despite rumors he might be fired. In early 2019, Powell addressed the markets directly. He made it clear he would not be swayed by political pressure, nor would he step down.
We will be patient as we watch to see how the economy evolves.
If the president asked you to resign, would you do it?
No. The U.S. economy is in a good place, and we will continue to use our monetary policy tools to help keep it there.
In March 2020, the world changed. As the coronavirus pandemic hit the global economy, Powell moved with unprecedented speed, slashing rates to near zero and launching massive bond buying programs to support the U.S. economy.
We reduced the target range for our policy interest rate by 1 percentage point, bringing it close to zero, and said that we expect to maintain the rate at this level until we're confident that the economy has weathered recent events and is on track to achieve our maximum employment and price stability goals.
Powell's leadership during the crisis earned him a second term. In November 2021, President Joe Biden nominated him to continue in the role, citing his steady leadership during the pandemic.
We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible.
We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched.
Powell was confirmed for a second term in May 2022 with broad bipartisan support. But he soon faced a new enemy, 40-year high inflation. He warned Americans the cure would not be painless.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, They will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain.
As the 2024 election approached and Donald Trump returned to the political spotlight, pressure on Powell intensified. Trump called him too late and a numbskull, while Powell insisted the Fed would remain independent of politics and election outcomes.
In the near term, the election will have no effects on our policy decisions.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
I think he's done a bad job, but he's going to be out pretty soon anyway. In eight months, he'll be out. But I call him too late. He's too late all the time. He should have lowered interest rates many times. People aren't able to buy a house because this guy is a numbskull. He keeps the rates too high.
Yes.
The final chapter of Powell's chairmanship was marked by a strange public dispute over building costs. The Department of Justice opened and later dropped an investigation into cost overruns tied to Federal Reserve renovations. Powell described the legal pressure as a pretext to influence interest rate decisions.
We're taking a look, and it looks like it's about $3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Yeah, it just came out.
Our notes had it about 3.1 as well.
3.1,
3.2.
This came from us?
Yes. I don't know who does that.
You're including the Martin renovation. You just added
our entire capital.
Yeah, you just added in a third building. Is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago. We finished Martin 5 years ago.
It's part of the overall work.
But it's not new. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president.
As he prepares to step down as chair on May 15th, remaining only as a member of the Board of Governors, Jerome Powell leaves an institution that has been battered by political and legal attacks. His final message remains a defense of the Fed's absolute independence.
But these legal actions by the administration are unprecedented in our 113-year history, and there are ongoing threats of additional such actions. I worry that these attacks are battering the institution and putting at risk the thing that really matters to the public, which is the ability to conduct monetary policy without taking into consideration political factors. It is so important for our economy, for the people that we serve, that they can depend over time on a central bank that operates that way, free of political influence. It's part of the absolute foundation of this amazing economy that we have. It's just one of the many reasons why the U.S. economy is the envy of the world. For the investigation to be well and truly over with finality and transparency. And I'm waiting for that, and I will leave when I think it's appropriate to do so.
As the central bank navigates a new era of leadership, the Powell legacy stands as a testament to the complex, often precarious balance between economic stability and the political pressures of the modern age.
Okay, let's now take a look at what else has been happening in the world of business this week.
The S&P 500 and the Nasdaq gained ground on Wednesday with a boost from artificial intelligence-related tech shares. The Dow actually fell slightly, while the S&P gained about 0.6%, and the Nasdaq added double that, with the two indexes notching record closing highs. The market looked past data from the Labor Department showing producer prices jumped by 1.4% last month, the largest monthly increase in 4 years. Tom Hanlon, national investment strategist with U.S. Bank Asset Management, says he isn't sure if these numbers will persist and what impact they will have on profits.
Obviously, manufacturers and other importers are dealing with high prices due to tariffs, and also due to high energy prices. I think the question is this a temporary bump in producer prices, or is it something that will ultimately eat into their profit margins? But we've seen strong investment in productivity tools, and we've seen profit margins remain pretty sturdy in here, which is driving corporate profits. But if this is a one-time blip, this can get managed through the corporate profit cycle.
The recent inflation data is dousing any remaining hopes for a near-term rate cut from the Federal Reserve. In fact, Boston Fed President Susan Collins said on Wednesday that a rate hike could be in the cards if inflation pressures fail to subside. Kevin Warsh, President Donald Trump's nominee to succeed Fed Chair Jerome Powell, was confirmed by the Senate in a vote along party lines. Stocks on the move included Ford, which surged 13%, following a Morgan Stanley report highlighting the strength of the company's energy storage business. And Johnson & Johnson climbed nearly 3%, after brokerage Leerink Partners upgraded shares to outperform from market perform.
Well, that is all for this week. Please do join us again next time for more World Business.